Switzerland is famous for a lot of things. Its tourist attractions, Swiss chocolates, Swiss watches, and of course, Swiss banks. It's where all the richy rich supposedly stash their money. That's because these are some of the safest banks in the world. But are they really? The last 2 weeks have shown us that the most decisive thing in banking is confidence. No matter how strong a bank, the big the name, if there is no confidence, it could soon shut shop. 3 banks, in fact, have collapsed in the last 10 days. First, it was the Silicon Valley Bank, Signature Bank, both in the United States, and now the 166-year-old Credit Suisse Bank. Credit Suisse is considered a globally systematic important bank. What that means is it's too big to fail. So if it collapses, it will have a devastating effect on the entire financial system, which is why over the weekend, the Swiss government stepped in, made another Swiss bank, a bigger one, UBS, buy it in a shotgun wedding for $3.25 billion and had to actually back them for the purchase. So why did Credit Suisse come to this point? The story goes much before the events of the last couple of weeks. For the last 2 years, in fact, Credit Suisse has seen one scandal after the other. Scandals that provoked huge losses. Confidence in the bank was at an all-time low, and suddenly it was difficult to access funding. Can you believe such a storied, globally reputed bank being accused of money laundering, being accused of funneling drug money? There was even an accusation that they used spies to look at what some of their rivals were doing, one of their ex-colleagues. A lot of murky stuff, and they've been pulled up. They have been fined by courts around the world for this. Now, on March 15th, things came to a head. The shares of Credit Suisse went into free fall. The bank tried to calm the markets, but it was all in vain. There were 2 primary reasons for this. One is a discovery that the financial reports of this Swiss bank, Credit Suisse, had some material weaknesses in it. Now, that statement spooked investors. Secondly, one of their very key investors, the Saudi National Bank, which owns 9.8% in it, said they're not going to put in any more money. That also made people scared. Things looked so bleak that over the weekend, Credit Suisse's biggest rival had to swoop in. Well, had to in the sense the Swiss government effectively has forced them to do. And they've forced them to buy Credit Suisse for $3.25 billion. The reason is that Credit Suisse is too big to fail. You have to stop a banking contagion. A banking contagion means everyone is upset, everyone's worried and starts withdrawing their money all at once. That's going to be a disaster. It sounds almost like a shotgun Swiss banking marriage, but that was necessary. Now, the rescue may have quelled some of the fears for now, but is it really enough? Because of this, 6 central banks have stepped in. In a global response, the US Federal Reserve, other top central banks, right from Bank of Canada, Bank of Japan, all have come in and said that they're going to work together to make sure there is enough money flowing through their banking systems. But is all of this going to work? What has caused this? Should we be worried about global banking? And are Indian banks safe? To speak on this, I'm joined today by Devina Mehra, Chairperson, Managing Director and Founder of First Global, and Ajay Bagga, Market Expert. Welcome to both of you, and thank you so much for speaking with us on Beyond the Headline, where we're trying to break the story down to all of our viewers, explain to them why it deserves to be a top headline and an important story today. Devina Mehra, great to have you on the show. Let me begin by asking you to very simply explain why all of a sudden there are concerns over such big names in global banking and the whole global banking system. Is there something fishy going on?
Thanks, Tamanna. As you said in the introduction, banking is a confidence game, and this is something my mother explained to me when I was in school, that we all put money in banks and they're supposed to give it back when we ask for it. But in reality, no bank in the world can give back money if all or even most of its depositors come back asking for the money, because that money has been deployed somewhere and is not sitting in cash in the vault to be given back to you anytime you ask for it. So that is why even the most solid bank in the world, if there is a crisis of confidence, it can go bust, which is why regulators move so fast, because they do not want people to be worried and panicked. And I'm sure we should not be spreading that worry and panic. And as far as, if you go back to the Silicon Valley Bank, that had a few peculiarities, because normally we think of banking crisis as arriving, starting from bad lending, that you lent money in the wrong place, it was not repaid, what we all talk of as non-performing assets in the Indian context. And when we think banking crisis arises out of that. But in the case of SVB, for instance, it arose because they did not lend out enough, and they put all the money in securities which were supposedly safe, or at least not very risky, but they were very long tenor securities, because at that time when they were investing, interest rates were close to zero. So in order to get any return at all, they had to invest in securities which were very long dated, and then they were not as liquid as treasuries either, and they could not, as the interest rates rose, and they rose very fast, like the Fed has raised rates by 4.5% in less than a year. Last time that happened was in 1980-81, which is even before SVB was formed. So that is why, crises recur in markets, because people forget history, people forget risk control. If you read about SVB, as with many other managements, the focus was on quarterly earnings, and they forgot about the risks. As far as Credit Suisse is concerned,
right? I was just going to come to that, Devina. SVB story is a very different story from Credit Suisse. You could say SVB, Silicon Valley Bank, funding startups, high flying, maybe forgot the basics. But Credit Suisse, that's an institution.
Yeah, but Credit Suisse, I tweeted this a few days ago. It was a flippant tweet, but there's a grain of truth in it, that there has not been a financial crisis in the last several decades where Credit Suisse has not been part of it. So, they are you can say a repeat offenders. They have been last 30 years, there have been multiple scandals. You mentioned some money laundering, breaking sanctions. They have been stashing losses in client books. You spoke of spying. So they have been just in multiple problems through the years. So it's not as if it was considered a very, very good kosher bank and suddenly this happened. No, they have been a repeat offender, and they've been there in practically every scandal to come out of the financial markets. So for people in financial markets, it is not so not such a surprise that Credit Suisse is in the middle of a mess. And of course, now it is the bank itself, in a sense, is history, because it is merged with UBS. Of course, there are other collateral things, like there were these tier 1 bonds, and you would normally think that whatever it is, unsecured bonds, but they should be one notch above equity, but they have been written off completely, even if equity has not been written off completely. So equity holders might be getting a very, very small fraction of what they were worth even a week ago, but they're getting something, whereas the 81 bond holders are not getting anything, which might affect that market. But the regulators move fast, and they have to move fast to prevent contagion. As of now, it looks that contagion has been contained. And part of the reason is that this crisis is not driven, unlike the 2008-9, by poor credit, or that there is that is the core point.
So unlike 2008, it's not like the banks have lent to people who can't pay back. And I'm going to put this very, very simply, is that they have invested in places where the returns haven't worked out well in time, and it's sort of spread all over the place. Ajay Bagga, I'm going to throw a sort of curveball at you. A lot of our viewers watching this are going to be wondering why this concerns them. Why should they know about this story? There's so much happening in the country right now, and we have chosen to showcase this story tonight on Beyond the Headline because it's important. It's also a reflection of how safe our global financial systems are, and eventually we're interlinked in India, isn't it?
Yeah. We are very interlinked. And I would have preferred you ask Devina this question because Devina and Shankar are my seniors from Citibank. What I've learned in banking, I've learned from people like them. So I was enjoying hearing her explain in very simple terms the entire banking fiasco that we are right now going through. So, the short answer is the linkage, Tamanna. We might not be linked in a direct way that, unlike even 2008, we had some exposures, our banks had some exposures abroad, very little in comparison to their balance sheet size. Now we don't even have much of that, but it's the foreign inflows that come in and that leave the country when there is trouble. We get hit more because A, our door is wider, people can take out more money from us more easily. The impact costs are lesser for us. And banks are a very big part of our financial markets. Nearly 30% of our capital markets are made up of financials like banks. So it has a big impact. The big issue here is that banks, when they lose confidence, it can lead to what we say contagion, where there's a lack of confidence. People say, "Let me just withdraw my money." And as Devina mentioned, you start a bank holding about 10 to 14% capital on which you have built a balance sheet of 100. And today, if more than 14 come to take back their money, or 14% of your loans go bad, you are not able to service that depositor, the 15th depositor who comes in. And that's what happened in the US. Credit Suisse was facing this across the last quarter of the last year. Nearly $100 billion went out of their bank based on what the issues were coming up. I think in the last 2 weeks, they would have lost a huge amount because they got a $54 billion line from the Swiss National Bank. The RBI of Switzerland basically lent them $54 billion and still they couldn't stay afloat. So that shows that maybe a big amount of their deposits had run out of the bank. And that's why, it was a forced merger that happened. So that's what happens in banks. One question which you had asked, will it happen in India? It's a very remote possibility. We have gone through a pain of nearly a decade of cleaning up our banks' bad loans. But today, we have about 5% bank loans, bad loans in India. The possibility is low, and our structuring of our banking is very different from what happens in the US. We have big amounts of reserves kept, and I would also venture to say supervision maybe is much more stricter of the Asian banks, including in India. That is safeguarding us.
Okay, so we have stricter supervision, more conservative banking. Devina, would you say that in these cases, both with Credit Suisse and, some of it will follow with Silicon Valley Bank, the way these banks are managed and the creme de la creme of managers sitting at the top need to be seriously questioned because billions of dollars of wealth have just evaporated. And at the end of the day, someone needs to explain why. Was this all just bad luck? Or underneath it all, we need to investigate and find out if there was gross mismanagement, maybe even criminal acts?
Yeah, we should examine that, but on the other hand, we should not go on a witch hunt because, as I told you, like in the case of SVB, the basic cause was that the interest rates went up, and you did not manage it well. But to call it criminal would be, I think, stretching it a bit far. And so mistakes were made, obviously. And in the longer term, this kind of bailout by regulators, that causes something called moral hazard. So now what is moral hazard? So for now, the problem has been contained. But what is moral hazard? That in subsequent rounds or subsequently, players might take more than prudent risk that if that the returns come to me, but if something goes south, the regulator is there to take the risk on. Where will it cause the moral hazard? In these cases, the shareholders have not got any money. So obviously, this is not a moral hazard for future bank shareholders, but it can be a moral hazard for management. So because both in the case of SVB as well as Credit Suisse, the managers have got their bonuses also before these bailouts.
Exactly. I think you
And
simplified my question, Devina. I'm not saying they
yeah,
should be behind bars, but in any job, if you flub up so badly, if you mess up so badly, you're not going to keep your job. You're going to be punished in whatever
yeah.
industry you are in, at least by, losing your reputation. The fat cats
So
at banks never seem to feel the heat.
well, I mean, in this case, yeah, maybe, I mean, once all investigations are done, they might have to return the bonuses, but for now they have got it. So I'm saying this is a moral hazard, A, for the management, B, also for large depositors, because earlier the insurance, let us say in the US, was for people who had up to $250,000 of deposits. There was no insurance for large depositors. And SVB actually had mostly large depositors because these were startups who raised money and put that money in the bank. So they did not even have to wait a day to withdraw their money because that bailout happened on the weekend. So that means that's a future moral hazard for any corporate looking to deposit large sums, that I don't have to look at how good or viable the bank is. I just go, let's say, for the highest interest rates or convenience or whatever. And then if there is a problem, the regulator will bail me out. So that's the other part of the moral hazard. In the GFC of 2008-9, that great financial crisis, I think there were also elements of criminality, but in the US, I see the focus is very much on keeping the system going, keeping the confidence, and just making sure nothing shakes the markets. And rather than pursuing and persecuting, so nobody went behind bars for GFC, though I think there was good case to be made at least for some of them to be there. So which is the other extreme from how India manages it, where we just go on litigating for decades together and not look to make the money whole. Harshad Mehta's case being a case in point, that the money was there to repay all his liabilities, but it's 30 years of cases and no money back to anybody.
Yeah. I want to understand the what next sort of aspect of this, Ajay Bagga. Is this the end of the story? Because Silicon Valley Bank regulators stepped in and they said, don't worry, aapka paisa mil jayega. And, I'm just keeping this very simple and basic. Credit Suisse, problem, no worry, we'll get a bigger bank to buy you. Sabko apna paisa mil jayega. Is this the end of the story? Or are there underlying sort of weaknesses in the global banking system that this has exposed and needs to be addressed?
They were exposed in 2008. Some measures were taken to mitigate them. But again, now this has been a new thing. What Devina mentioned, this kind of interest rate hike was unprecedented. It's ended a 40-year post-Volcker era, where Volcker was the Fed governor who really broke the back of inflation in the 80s with very high interest rates. And then we saw stability. Now we have got high inflation, high interest rates, and the bankers of today were not ready. Their balance sheets were not ready. Processes, I'll give you two examples. SVB, the bank that failed, Tamanna, BlackRock's consultancy arm did their internal audit, and they said, even for a week, you're not aware how your securities are performing. I would need, sitting on a bank blotter, I would need by the minute what is my mark to market. And if for a week you don't know what's happening, God save you. Same thing with Credit Suisse. When Bill Hwang was a hedge fund manager, Credit Suisse was facilitating him to take positions in the US market by lending the name. When he went kaput, all the other banks sold off his collateral early. Credit Suisse took 2 weeks to even figure out how much is the exposure. They thought 2 billion, then it went to 4. Finally, they wrote off $5.5 billion. And they were so late in it. So, the risk controls, the mismanagement was very embedded in the culture for both these banks. Now, is it ended? No, it has not. Today, the First Republic Bank in the US will be bailed out. Last week, it was given $30 billion by 11 big banks. They put deposits. Now, that is not enough. Today, again, it is seeing a run. It is down 39%. That 30 billion is being converted into equities. And like Silicon Valley, like First Republic, there are 200 more banks which have about $100 billion of assets or who don't have an answer for depositors and for which the government has to stand guarantee. What is happening is when they took the risk, it was private profit. They pocketed the profit. When the losses are coming, the taxpayers are being brought in. So socialization of losses, privatization of profits. That is what's happening, and that is the scary part. And once these banks start failing or they can't meet the redemptions, then it becomes a domino effect. More and more people will want to pull out money from the smaller banks. We have seen big banks are getting this money. That's how they funded the 30 billion. Each of them is getting 10, 15, 20 billion a week from the smaller banks. Like I told you, Signature Bank was 88 billion. They lost 50 billion in a week. Silicon Valley, thanks to the social media and thanks to being in the private equity, investee companies having invested, they all were together in WhatsApp groups, everything. $42 billion, Tamanna. We saw this savings and loan crisis in the US. It took 10 years to fructify. You had to stand in lines, fill forms. It would take so long to get your money out. In a few hours, Silicon Valley Bank lost $42 billion. That's the social media for you. So it's a new new reality, meeting old banking with very weak risk and very poor supervision. That is in a crux what we are going through. It's not ended. It will continue. India is safe. Indian banking is safe because we are isolated from this.
Okay, let me just add to that.
Yes, I was coming to you, Devina. Yes.
Yeah, I'll add something. It's just an interesting tidbit that after the regulators said that they would guarantee all the deposits of SVB and also of other banks who need it, SVB actually has been marketing this. They are advertising this, saying that give us your deposits. This is the safest place in the world to be because all our deposits are guaranteed. I mean, I'm not making this up. They're actually marketing.
The cheek. Imagine the cheek of it.
And Tamanna, HSBC bought SVB's UK arm for one pound, okay? So 6 billion balance sheet, which they valued at £1. And after HSBC bought them, the management paid themselves bonuses of about 20 million pounds the day after. I mean, if this is not criminal, then what is? How can you do that?
Which is exactly my point. I mean, we've started this show to explain to people what's happening. And again, there's nothing to panic. Your money is safe in your banks. Indian banks are super, super, super duper safe. I cannot, underline that more. But it's really, there's something rotten going on. Devina Mehra. It's something rotten going on. And my question is, has it been stemmed? Has this cauterization and bandaging of the global banking system by their respective, central banks and governments been enough? Or is there a deeper treatment that is going to be required, and will we see more symptoms festering?
I mean, fingers crossed, there might be more banks, as Ajay mentioned, who might be in trouble, but I'm sure the regulators, and they've already said that they will backstop any kind of liquidity issue and basically insure the depositors. So US has said it explicitly. And I must say that after US did this, the European regulators and banks were very upset with the US because they had in the past said that this should not be done, and they were like, they did it in a day. So I mean, as I said, this might have longer term repercussions in terms of what other risks people take. But that aside, for now, I think, I mean, as far as is known of what the dimensions of the problem are, the regulators can manage if there's nothing else coming out. As I said, because it is not a credit crisis, though. I mean, there's one thought in my mind which has been bothering me, that the regulators knew they were raising rates at an unprecedented rate, at least unprecedented in the sense of being in anybody's living career memory. And therefore, they would know that that all banks with high investments would be exposed to great price risk, because as to explain to your viewers, as interest rates go up, bond prices go down, bond or any fixed income prices go down, and the longer the tenor of the bond, the more the prices go down. So this should have been a kind of a red flag for regulators, that we are raising rates so rapidly and this can cause problems in banks. So I don't know what kind of regulatory oversight also was there, because this is not like a problem which came out of nowhere that nobody knew about.
Yeah.
It came directly out of the actions of one section of the regulator. So this, I would say, is also a problem of regulation.
Yeah, what were the regulators doing? What will they continue to be doing? You know, are global banks really functioning the way they should be? A lot of questions being raised from this, but I really want to thank you, Devina Mehra and Ajay Bagga, for joining in and explaining so beautifully and in such a simple fashion what really has been going on. It's a very important story that our viewers should know about. So thank you for that.